decision maker panel survey reported a small reduction in uncertainty over Brexit and among business leaders in the last 6 months. With the transition agreement reached in March, will there be? Does uncertainty remain high, or has there been will there be an improvement?
If I may begin on that, that's right. We've seen a small reduction, as you would hope. And we have an agreement that still has to be ratified, obviously, but it's an agreement between 28 heads of government, and it's an agreement that's in the interests of both sides to be followed through. The very limited early information, we see a bit in the Deloitte CFO survey in terms of Brexit uncertainty versus just overall effect of the relatively weak state of demand at the moment, and the decision-making panel results that we watch closely and supplement with direct conversations. Thus far, it doesn't look like it's having an impact, but it's very early days, and I'd go back to the earlier exchange, which is that obviously the progress on the end state that we would all the final agreement that we would all anticipate over the course of the year will really be decisive in this regard, I would expect.
Great. Did anyone else want to add anything to this question?
The only thing I'd add is that, and obviously we would hope that the agreement would give some upside on investment and on our investment forecast. I mean, another source of evidence that we've had recently was the bank agents' survey of exporters, and actually that was a bit more mixed than the Deloitte survey. Different, but it's different timing in terms of different frequency, but it did come out since the transition agreement, and that suggested that some Brexit-related factors were actually moving up the kind of league table of concerns amongst exporters. So it's not an unambiguous picture yet, but if we get more certainty through this year, then we would hope to see some improvement in the outlook for business investment.
Okay.
Is that survey public?
Yeah, it was published alongside last week's regular agents report. Yeah.
Thank you. And just linked to this point, so business leaders attach 40% chance of a disorderly exit from the EU, according to this survey. So presumably the need for a smooth Brexit is critical and could have a major effect on investment. Could you say more about what this looks like in the event of a disorderly Brexit, as the 40% think, and a smooth Brexit, and what that would entail?
Well, I think the first thing is to bring it back to the committee's forecast, which does assume a smooth transition to an average of potential outcomes, and that's been our conditioning assumption since the referendum, and it's a conditioning assumption which, by and large, broadly reflects the expectations of businesses and households. And I think there was an exchange earlier about the importance of those expectations. That's what drives the decision to spend or to invest. And so even with the decision-making panel information and the conversation we have, in general, businesses are behaving as if there will be a smooth transition, but they're less certain about where that outcome is going to be, and so they've been holding back, as we discussed earlier. The second point, in terms of what it could look like, if I can switch for a moment to the Financial Policy Committee and roll on that, and this is an area where there is coordination in terms of information sharing, very importantly for the MPC, which is that the Financial Policy Committee is thinking actively, analyzing what could go wrong if there is a cliff edge Brexit, if this is not a smooth process, and what are all the issues that need to be addressed in order to minimize the impact through the financial system on the real economy. First and foremost was to make sure the banks have enough capital and liquidity. We did that in the last stress test. We've extensively reported on that. We're very confident in that position, just to be absolutely clear. Secondly, there are a host of issues ranging, a lot of them in the derivative markets. There's 10 million insurance policies in this country that would not be serviced. There's, as I say, in derivatives, there's more than 25 trillion of derivatives that would have issues with the continuing to be serviced and function. There are a range of issues with data, et cetera, et cetera. We have published those issues. We publish every quarter as the FPC a checklist that's helpfully linked in sort of green, amber, and red, both for the UK and the EU, because they're cross-border issues, what's being done and what needs to be done to address them. And then the last point is, and we're working with the government where the UK government can help find the solution, so there's close and I would say effective cooperation there. The government's already announced some things that will be helpful in that regard. Last point is that we are, and this has been announced, is that a working group has been formed between the ECB and the Bank of England. I co-chair it with President Draghi to manage risks around the exit date, and so there's cross-border cooperation as well.
And just to remind us all, what's your definition of a smooth Brexit?
A definition of a smooth Brexit. A definition, I start with the financial sector, a financial sector that continues to meet demand for credit, and for businesses that the new trading relationships or arrangements are seamlessly implemented. So we move from our membership of the European Union, of the single market, to whatever those new trading relationships are. That last point would generally require a period of transition, as has been acknowledged with the withdrawal agreement, or the implementation agreement, I should say, not least because businesses will need to adjust their supply chains to varying degrees, depending on the final agreement. Also potentially need to make adjustments to key personnel as well. We at the bank, last point, can focus on and are focusing on a series of issues in the financial sector, with a particular focus on if there is a sharp Brexit, what could go wrong, and what can we do today to minimize the disruption that would come from that. But there would be, in the event of a sharp, if the implementation agreement doesn't come to pass for whatever reason, there would be potentially considerable real economy adjustment.
So there's been lots of debate about the transition period lately and whether it should be longer. What's your view on that?
I watched the debate with interest.
Sorry?
I watched it with interest. Look, we are...
the current time frame is adequate in your view?
It's what's been agreed by the leaders of 28 nations. So, in terms of the financial sector, we are actively, the FCA and the European authorities are actively engaged with the relevant parties to transition, to minimize these cliff edge risks. Exactly what we're transitioning to is, just like everybody else in the economy, is not yet clear because the end state hasn't been there. But we will look to use all the time.
That's taken quite a long time, and I know there's been a lot of will on the UK bank and regulator, central bank and regulator side to get on with planning as much as possible, given the end state's not known. But that's taken quite a long. I mean, the ECB only agreed to that, or only given permission to enter into that agreement fairly recently, weren't they?
We're pleased to have the working group set up. It's important, and we have shared interests in managing these issues, and they have all the right people working on them. So
you wouldn't have an objection to the time period being extended, would you?
I'd have I think some would have an objection to me answering that question.
Is that not bit of intelligence that gets past the Treasury, not by this committee? Okay.
Just two very brief but final questions. At the last TSC, you referred to the committee meeting here. You referred to economic uncertainty caused by Brexit. By the vote will knock 5% of UK wage growth by the end of the year. And also in January at the Davos conference, you said that the Brexit vote is costing Britain's economy around 10 billion a year. Have these figures changed in the light of the transition agreement and developments since those statements, or do you stand by them?
No, I stand by them. I mean, we're 4% and counting on the. I gave the figures earlier, and that's a figure that's just relative to what we forecast in May 2016. It's not adjusting up as one might expect, given how strong the global economy is, where this economy might have been. But look, we're in this, we're managing through the situation. We're going to set monetary policy to keep the economy, get the economy at full capacity and bring inflation to target, provide the supports needed, and we're working actively with things we can do with the government, with the ECB and the European authorities to prepare for any adverse situation, so people can have the confidence to save, hire, spend, invest.
Sure. I just have one final question because other witnesses haven't had a chance to answer. Earlier on, Governor, you mentioned the fact that household income was around £900 a year less than might have been the case in the pre-Brexit scenario. Given all this analysis that's being done around and managing risks, have you been looking at what the likely scenario is on household income going forward in the event of a disorderly Brexit versus some of the other scenarios? Who would like to come in on this point?
I mean, just to I mean, there's a kind of distinction between what's happened to date, which is what your exchange and earlier exchanges with the governor were on, where relative to the May 2016 inflation report, we've forecast up to 2018 Q1, we've had weaker nominal wages and higher prices, and that gives you a hit to real wages that translates, or into real household incomes that translates into these figures, £900 or so up to £1,000 on real wages. That's up, that's to now. When you link it to average earnings in the economy are about 23,000 a year. That's how you get that calculation. Then looking ahead, I think again, as the governor was emphasising, from an MPC perspective, we assume an average of end states and a smooth transition to those. That's what our forecast is predicated on. That's what drives our real income forecasts for households, our wages forecasts, our inflation forecasts, our real wages forecasts. From an MPC perspective, we're not looking at scenarios, and from an FPC perspective, as the governor made clear, we're confident that the financial sector could deal with the shock of a difficult Brexit, and we've modelled that, and that was a key part of how we analysed the financial stability risks around a transition that wasn't smooth.
Thank you.
Can I
yes, please. Sure.
Sorry, since you quoted me, I'll just caveat that last. The banks have the capital and liquidity to continue lending. There are specific issues which we have detailed as the FPC publicly released. We've got a checklist. We're working on them. And so those need to be addressed for the avoidance of doubt.
I'm sure people will be rushing to look at the warning, red, amber and green. So